What's going on, YouTube? Today I'll be talking about 3 Dividend King stocks that are showing really good buying opportunities as I film this video. So today is December 4th and we're going to be talking about some dividend paying stocks. Now, the first thing I want to cover is what a Dividend King is. So a Dividend King is a dividend paying stock that has increased their dividends every single year for at least 50 years. You may have heard of the Dividend Aristocrats, which is also an exclusive club to be in. But to be a Dividend Aristocrat, you only have to have had your dividends increase for 25 consecutive years. So this is definitely a more exclusive club. And with that comes perhaps more mature territory. Now, by design, these stocks have to have been around for at least 50 years, right? That's by definition, by design. But the other thing that comes with the territory is a lot of these stocks, in order for them to do that, have to have had expanded their business models across different industries. So whether that means acquiring different companies across different industries or internally developing your own products, most of these companies don't just operate within one single industry. So that's another reason why, even in terms of market volatility and uncertainty and recessions, when you have multiple streams of income, as a business, it's a lot easier to have a payout and guarantee that it's going to be more than the previous year, because that's a pretty big promise to pay. With that being said, I also want to talk about the, appeal for Dividend Kings for a lot of investors, including myself. Now, yes, one of the easiest ways to increase your yield on cost or increase how much money you're going to be getting paid through dividends is to reinvest your dividends. That's a very simple way to do that. So if you have something like M1 Finance, very possible to increase the amount of money that you're earning just by dividend reinvestments alone. That's great. But at some point, you're going to want to cash out. You're going to want to put your dividends in your pocket and take them home, maybe pay some bills, maybe just increase your salary or the amount of money that you're taking home, whatever. It really helps to have two things. Number one, a guarantee that these companies are not going to cut their dividends. So there is not that much that's guaranteed in life. Obviously, any one of these companies can go bankrupt tomorrow, and we that's just kind of life. But if there was going to be one type of company that you would try to steer towards in order for having something that's very safe and secure, a Dividend King is a great place to start. Number two, once you eventually do cash out your dividends and you want to have some kind of supplemental income, if you're investing in Dividend Kings or Dividend Aristocrats, you will receive a raise just for being a shareholder. So on average, a lot of these stocks will pay around a 5% increase every single year. So that's a 5% raise just for being a shareholder. A lot of people don't even get raises at their actual jobs. Maybe they're too scared to ask for a raise. Maybe they're not qualified to ask for a raise or something like that. But these, you will get a raise, no hassle required. Obviously, some of them only increase their dividends enough to be considered a Dividend King. So the increase from year to year may be only, let's say, 3% for 1 year. But some of these are actually a little bit more generous, which is what we're going to talk about today. So let's just jump right into the video. So the first stock I want to talk about is actually going to be 3M. Now, in terms of security and stability for price appreciation, 3M is definitely one way to go. So since the recession of 2008 right here, where 3M lost about, I want to say, 55% of its value, that's quite a bit. There have really only been maybe two major periods of major consolidation. So the first of those was here in the summer of 2015, which is when the entire stock market saw a correction. And the second is right now. So from the peak to the trough, from the high to the low, 3M has lost around 30% of its value. However, it is still on a 22% discount. Now you might be thinking, okay, if these are stocks that we want to buy and hold forever, why does it matter if we get them on a good discount? Well, two things. Number one, nothing in life is certain, and we may actually need the money later. So even if these are stocks that we intend to buy and hold forever, let's say we had to sell our stock, it'd be a lot nicer if our stock was worth more than it was when we purchased it. So by buying things at a discount, you kind of have already that kind of insurance policy. You know, buying stocks at 52-week highs isn't usually the best way to go, especially if you're going for capital appreciation. That's the first reason. But number two, by far the more important reason, is the starting yield will be a lot better when the stock is on a discount. Meaning you can get more bang for your buck or more shares. Let's go ahead and take a look at 3M. The starting yield for 3M right now is 2.61%. So if you purchase 3M right now, your dividend yield will be 2.61%. And the other thing I mentioned about dividend increases is this. So from 2017 to 2016, 3M paid $1.18 per share. From 2018, it paid a $1.36 per share dividend yield. So that's an increase by about 15%. So 15% for a dividend king. Wow, that's quite a bit. Now, it's not always going to increase its dividend yields by about 18%, but just the fact that it's done it once gives you kind of idea of 3M being kind of more generous than a lot of these other dividend king stocks. The year before that wasn't super spectacular. It was about 6%. So on the lower end, it could be around 6%. The year before that, it was about 8%. So a lot better than, 4% like these other ones. But from 2014 to 2015, this was a dividend increase of about 16 divided by 86. 86. Of about 18%. Wow. So 18% here and 15% here from 2017 to 2018. That is huge if you're thinking about increasing your income every single year. So 3M is a really solid pick. And the other thing that I mentioned was 3M is obviously very diverse. So they have industrial and consumer products. So they appeal to everyday people. They make tape. They make cable linings, things like that. But they also appeal to businesses that are trying to do things at industrial strength, like build airports or build buildings or things like that. Its business segments are industrial, safety and graphics, healthcare, electronics and energy, and consumer. So clearly a quite diverse array of products. All right, moving on to the next stock on the list. This one a lot of people haven't heard of. It's called EMR, or Emerson Electric Company. So Emerson Electric Company is a little bit more volatile than 3M, or the other stock that I'll be showing today. So from the recession of 2018, Emerson Electric Company has seen 3 significant periods of volatility. The first one was here in 2011, where EMR lost about 36% of its value. The second one was here in 2014 to 2015, where EMR lost about 40% of its value. And we are currently in the third one, where EMR has currently lost around 17% of its value. Let's just say 18%. So currently at an 18% discount, not as large as the other two consolidation periods. So if that's kind of any indication, maybe that's signaling that there could be some more downside. I probably wouldn't try to predict that. That's not really my biggest concern here. What I do know is that we're 18% off the highs. So what is the starting yield with Emerson Electric? Currently at 2.85%, so that's more than 3M. However, the rate at which it's increasing is not as high as 3M. So from 2018 to 2017, it was an increase of about 2%, which is not all that much at all. The years before that, it was again another 2% one. And the highest over the last 5 years has been from 2014 to 2015, which was an increase of about 9%. So the average there is maybe around 4%, 5%. And I think you can expect that going forward with EMR. So the reason why I have it on this list today is because I think the starting yield is pretty good at 2.85%. So even if you just want something for the next 5 years or 10 years, I think this is a pretty solid bet. Now, EMR is also quite diverse. They are engaged in designing and supplying products and technology and delivering engineering services and solutions in industrial, commercial, and consumer markets. So once again, like 3M, they make products that appeal to businesses and consumers. Fun fact, EMR was actually the largest manufacturer of armament for airplanes during World War II. And since World War II, they have actually had maybe 3 major acquisitions. One of them was an electrical company. The other you can probably look up on Wikipedia. But still, EMR is concerned with purchasing smaller companies that are able to do products that they're not so good at right now. So still willing to expand their business. And that's why they're dividend king, obviously. And the last stock on this list is Colgate. So in terms of safety and security, in terms of capital appreciation and something to anchor your portfolio, Colgate is the way to go. They have had only one major significant period of volatility since the 2008 recession, in which they lost 32% of their value, which is not as much as 3M, which was 50% of its value. But the other period is right now. So currently, Colgate is 20% off the 52-week high, and from the high to the low, it lost around 25% of its value. So if you want something to anchor your portfolio and not experience heavy swings and volatility, I think Colgate is a perfectly safe bet. So that's kind of a multi-purpose type company with Colgate. It's not just there for the increasing dividends. So because we're on a discount, what is the starting yield? So currently we're starting at 2.64%, which is not as much as Emerson Electric, but that's totally fine. The rate at which they increase their dividends is a little more than Emerson Electric. So over the last year, it's increased their dividends by about 5%, which was about 2.5 times more than Emerson Electric. And I think that trend is going to continue. I think you can expect something around the 5 to 6% range rather than the 4% range for Emerson Electric. And in terms of products that Colgate sells, it provides services such as oral care, personal care, home care, and pet nutrition. So clearly a wide array of products for Colgate as well. And that's actually where I want to leave this video. So in summary, dividend kings are great for for increasing dividends. Obviously, there's also the safety of being invested in a wide array of products. And all in all, if you can get the best of both worlds, which is increasing dividends and good capital appreciation, and then even in cases like Colgate Palmolive, where you get really good, defensive type status, then you basically win. So one thing I want to link in the description below is this website, which is by suredividend.com. They were nice enough to provide a list of dividend kings. I believe there's around 25 of them. You can sort by market cap. So Johnson & Johnson, Procter & Gamble are some of the larger ones. And you can sort by dividend yield if you so choose. Coca-Cola is some of the larger ones, and Procter & Gamble is here as well. Emerson Electric, which is what I just talked about, is there as well. So anyway, that's it for this video. I hope you guys enjoyed it. Let me know if you have any more requests for videos. I'm steering more towards dividend growth and things like that. It just feels kind of nice to have something that'll, not just work for you and you can increase your dividends, but will actually increase the rate at which they pay dividends, which is a double win for me. So that's it for this video. Hope you have a great day and good luck trading.